So if you're always wondering what to do and what not to do when it comes to technical analysis, this video will definitely help you. I have 3 do's and 3 don'ts for technicals, how to place them, what to do, what not to do. So let's get right into it. We're going to start with the do's and then go into the don'ts. So first off, you want to understand what more eyes, more volume, more traders, better signals means. That might be a lot, but what you want to do is you need to find technical levels that are common, so to speak. The more people that are actually watching that area, if it's a very pronounced area on the chart, and we'll get into that more here in a little bit, but that's where you're going to have the best odds of success. Now, sure, some funky levels might still trigger from time to time, and that's where a lot of new traders, beginning and novice traders, kind of get it wrong. This is about consistency over time. Consistency is the name of the game. So you want to go with technical levels that have the most eyes. The more traders that are watching that level, if it sticks out like a sore thumb, that's the level to go with. So we'll get into more of that here on the next one. Using volume as a guide, number 2. So volume as an indicator is important, and that has a lot to do with your technicals. So when you're choosing these technical levels, it's important to understand that volume is your friend. And what I mean by that is when you have a specific level, check down below, right below, we're using the daily chart. So you want to check right down below the volume of that day. Was it a really low volume day? If that's the level that you're striking and that you're going to watch the next day or the following week or following month, and there's no volume there, well, it's not going to hold. There's not enough traders protecting that area, because that's what technicals boil down to: protection. It's about people in the past that have already bought that position that will then, now, if it comes back down to retest that level, they're going to protect their initial investment and their initial trade. So these levels have a lot to do with volume. Now, don't get confused by one level having low volume. You need to look left. Okay, so when you look left, you're basically looking at historical data to tell you whether there is multiple touches there at that level. Let's take, for example, a stock, and you're looking at a technical level of $119, okay? Whatever it is, or $3, doesn't matter. If you have multiple touches right at that area or in the area, remember, there's always a little bit of give and take with this. That doesn't need to be absolutely perfect, right? If you have multiple touches, add up that volume. Because again, if there are 3 touches of that level, but it's very, very low volume, the odds of that holding as it comes back down to retest where you're going to buy or go long, it has bigger odds of failure there. So we want lots of volume in those areas, in those technical areas. That's really key. I've noticed through the years of teaching traders how to trade, when I get them to pick their levels, they go with a very common level. It's right in your face, but they're not checking the volume. Fast forward on the day, it fails, and then they wonder why it fails. Well, there's no volume there. That's exactly why. So you want levels with lots of volume. That's really important. I cannot stress that enough. So number 3 of the do's. Now, this is where a lot of people will kind of make a lot of mistakes, and they'll get pretty fancy with this stuff. Don't. Keep it simple. So simplistic technicals work for a reason, okay? And we're going to discuss this quite a bit in number 3 here. So we want to use horizontal, so just straight levels, horizontal levels, and trend. That's essentially it. Now, keep in mind what I'm telling you guys to do in this video is for beginners and novice, maybe a little bit of intermediate traders. Professional traders already know this type of information, so they know that they can go beyond the little bit of basics. And this isn't just, now don't get that twisted either. The basics, that's how I trade. I've never deviated from the basics because the basics work. You need to keep things simple in this regard. When you start getting really fancy with your levels, maybe you're drawing something like really wild, there's a reason why it's not going to work. It's because, again, you need number two, the more volume, and then number one, the more eyes on that, it just works. It's going to work because you have more and more people actually watching that level. It all boils down to simplicity. So that's really key. That's really crucial. Now, I'm not saying there's not some sneaky little levels that are out there. Okay, there definitely are, where institutions will kind of hide and wait to pounce. And that's going to take training and a lot of experience in order to spot those levels. So again, don't get it twisted. You can get pretty funky and pretty crazy with your technical analysis. I know these aren't technical terms, but that's how it is. You can, but again, it is about the basic levels. And the reason for that is when we talk about, like, a lot of people think that algorithms, institutional algorithms, are highly complex. They're not. They're actually quite simple. The majority, like 80%, 70 or 80% of all algorithms are based off of support and resistance, traditional support and resistance, and trend. A lot has to do with trend. And these are very basic trend, like multi-week, multi-day, even multi-month, multi-year trends. Very simple, straightforward trends. That's how they have to base their algorithm. Because again, the smart money knows that simple works. Why? Why do they do that? Because retail traders, that's how institutional operations make their money. They make their money off of the dumb money, us, retail traders. So it all boils into that. These are all puzzle pieces that you need to put together. It's not a complex puzzle. It's actually a simple puzzle when you think about it. And this is why I have such success with my strategy, because it's very simple, and it's based off of how the dumb money looks at things, because in turn, that's how the smart money will look at these things. Okay. So again, keeping things very basic with your levels is paramount. You need to use horizontal levels and trend. Now we're going to get into a little bit more of what not to do, and that's where I'm going to talk about indicators and stuff like that. But when it comes to the algorithms and these smart money levels, I'm going to need to do a follow-up video, because that could be a video just in itself. But I'm just giving you guys kind of a broader view of what to do and what not to do. So if you're interested in that video, let me know below, so I don't waste my time doing this. But I can show you where to find these institutional levels. They're sneaky little levels. They're not very common, but when you see them, you know that that's what's there. That's where the actual buying or selling is going to take place. But again, to wrap up number 3, keep it simple, guys. Like horizontal and just and trend, and that is it. Do not get crazy with it at all. People will have a tendency to want to be the smartest in the room and dazzle people that they know with their technical analysis. Don't. You're falling for a trap of ego is what you're doing, and it's going to do nothing but leave you completely blown up with your account. Now, again, will some of these funky ways of doing technical analysis and like real fancy ways of doing technical analysis work? Yeah, it will. It might work 50 times in a row, right? But it's not about 50 times. 50 trades, 50 times in a row, 50 green days straight. Yeah, it's good, but that is not going to carry you throughout your career. These strategies that you come up with have to carry you for your entire career. Just like my strategy, take it for example. I've been running this exact same strategy, for 10 years. That's 10 years of different markets. Look at the markets we've been through. Look at the different presidents we've been through. Look at the ups and downs and everything else. And no matter what, day after day, it works. It's because it is simple and it follows the rules that I am going over right now. Okay. So let's go into the don'ts, and that'll kind of carry on into the number 3 of do. So number 1 don't of technical analysis. Do not fall for the trap of complicated. Now, what I mean by that is your indicators. Your indicators that you are going to use and choose are important. There's a million different indicators out there, guys. There's companies that want to sell you software with their fancy indicators. Don't. Please listen. If you take anything away from me on this video, it's this. Don't fall for that trap. It's a trap, guys. Those indicators do not work. Now, the indicators you can use are simple moving averages, but that's about it. And don't get carried away with that shit either, okay? It's important, again, to keep things simple. Where people fall for the trap is they will see people pushing or promoting a certain indicator. Like, I don't know, we'll use the 13-day moving average, okay? Now, it'll work, don't get me wrong, but if you really think about it, guys, and this is how I thought about it years ago, whether you use the 9, you'll see a lot of people battle it out on financial Twitter over what, or financial X now, over what indicator works the best, the 9, the 10, the 11, or the 13. Who cares? Do you realize the price point at which you're talking about and the spread in that price point? It's all within your risk anyways. One of the reasons why I've been able to keep my strategy working and it'll continue to work forever, like no matter what the market throws at me, is I understand that if it falls within my risk strategy, because I also have a risk strategy, if it falls within my risk, I'm covered anyways. So why cloud your mind with all of these different moving averages and everything else that it doesn't matter? The difference between the 9 EMA and that 13 EMA are right there. It doesn't matter. It's silliness. It's really, when you think about it, it's fucking stupidity is what it is. And that's what it boils down to. Don't get caught up with indicators, guys. Pick one, go with it. Use a short term, a medium, and a long. That's it. That's all you need. It's going to get you so bloody close into that price point. You're going to be starting in on that position anyways. Don't worry about it. The indicators that I use are simple moving averages and some exponential moving averages. Exponential for really short, so the 5 and the 9, and then simple moving averages for the 20, the 50, the 100, and the 200. That's it. Don't get carried away. And when it comes to RSI and all of these, like the Vortex, stop, cut it out. You don't need it, okay? Use and rely on very simple technical analysis. Horizontal lines, trend lines, simple moving averages, that's it. Now, a lot of people will ask, what about VWAP? Well, VWAP needs to be used in a very specific way. I do have videos on my YouTube where I discuss exactly how to use VWAP. And even then, I don't recommend using it because where you are at in your trading career, you need to know your wheelhouse. Your wheelhouse means your skill set, where you are as a trader. Don't worry about that stuff. You don't need it, okay? It's a very specific look and a very specific setup that institutional traders will actually use that VWAP. They do not use it all the time, okay? So when people start talking about VWAP, run away from them. They don't know what the fuck they're talking about. Straight up, okay? You got to trust me on this, guys. I'm not here to bullshit you. I'm not here to waste your time. So that's really important. Be careful of those indicators that you use. I cannot stress that enough. So another thing that we're going to talk about is, so this is number 2, multi timeframes, your different timeframes in your technical analysis. Now, again, don't get my words twisted. I'm not saying that they don't work, but you don't need them. Use your daily chart and your short term for your day trading, which I use the 1-minute chart. I recommend using the 1-minute chart. A lot of people, when they first start trading, they're like, well, it moves a little fast. You don't have enough data. Yes, you'll get used to it. It's like learning to tie your shoes, guys. Everybody did not know how to tie their shoes the very first time they tried, right? And now I'm sure most of you, I would hope most of you can whip those off real quick. Same thing with using that 1-minute chart. Just get used to the 1-minute chart and the daily chart. But mainly rely, when you're setting your technical levels, off of that daily chart, guys. That daily chart is your Bible. I cannot stress that one enough. Okay, so when it comes to all of these different time frames, like your weekly chart, your monthly chart, Those are they're okay. I don't want to say that like do not use them ever. But out of the 252 trading days out of the year, I might pull up a monthly chart or a weekly chart maybe 3 or 4 times if I'm looking for a broader view, if I want to check a really wide trend. Okay? That's it. Don't get carried away with that. And I'm going to explain why. Because people will want to debate me on this. You're not going to win. You won't debate me and win on this. When it comes to these multi time frames, you're falling for the trap. There's not enough volume there. What is the number one chart that all investors and day traders, swing traders use? It's the daily chart. So again, it boils down to the do, number one, with the more eyes, the more volume, guys. All of these rules that I'm giving you may sound really simple, but this is the stuff that makes you money in the stock market, guys. Straight up. Okay? It's not about complicated. Don't get fancy with it. I must have repeated that 20 times by now in this video. It's for a reason. Don't get crazy. So, and I think the biggest trap that people fall for with time frame, and I've seen it lots. I've seen it lots where people will say, okay, so this is the secret. This time frame works the absolute best. Okay, you ready for the secret? It's the 13-day chart. It'll blow your mind. Bullshit, get out of here. Go sell your bullshit somewhere else, because that's what's going on. When you see people trying to sell complicated or secret, they're selling you trash. They're salesmen. They're not traders. There's no professional day trader out there that I'm telling you, that is actually a legitimate professional day trader that will use something complex like that or off the wall. Because as a professional trader, you know you need to follow where the volume is. Now, it's about following the pack in certain situations when it comes to being a trader. You cannot follow it all the time. You still need to be, like, I'm a contrarian trader. I generally take the opposite route. Like, if that stock is selling off real hard, I'm going long. If that stock is ripping up real fast into technical levels, I'm going short. So I'm not saying follow the pack in all situations, but when it comes to technicals, you kind of have to. Because again, the more volume, the more eyes, the more traders, the better the buy signal or sell signal. Okay, so when someone's trying to sell you some bullshit like 26.5-day chart time frame, it's nonsense. Don't fall for that. It doesn't work. It's no different than a weekly chart or whatever. Just stick with the daily chart and the 1 minute chart. If the 1 minute chart's too crazy for you, you could go to the 5 minute, but that's way too long. I highly recommend the 1 minute chart. And the daily chart, there is absolutely no debate on that. That is an absolute must. So I would say that, to wrap this one up, because I've kind of covered a lot of don'ts. There were 1, 2, 3, but they're all kind of wrapped up into one. I could go on and on and on about the don'ts. The do's are very simple. There's maybe 3, 4, 5, 6 do's. That's it. Okay. Now, when it comes to actually plotting these levels, there's a little knack to it. You got to have an eye for things. But the more that you train your eye, the better off that you'll be. It's like anything else in life. When you are looking at these charts, you need to remember that it's another language, because that chart, the way that chart is moving on that computer screen, it's a language, and you need to become fluent in that language, and that's what it's about. But as for the don'ts, there's a lot of don'ts. And one of the reasons why there's so many don'ts is because there's so many people out there trying to sell you bullshit and garbage. They're trying to sell you blue sky. So I tried out this new charting software, and it had a lot of like funky indicators. And I don't want to name it because they're really nice guys, and I dealt with them for a while. And they even had different candlesticks, and I'm not going to mention it because it's very apparent who it is as soon as I say that. And I think they're a great company and everything else. They think they're not trying to sell you bullshit and mean to sell you bullshit. I think they generally think and genuinely think that it works. And it's no different than the candlestick chart, guys. okay, at the end of the day. So, like, with that said, that's what all of these people are doing. They're just trying to sell you a bunch of bullshit. And that comes with like everything, like indicators, charting software that does things for you. Listen, don't fall for the trap of automatic algorithm trading. You don't need it. These algorithms that they're trying to sell you are not set up for complex market conditions. You need a human touch in order to be a successful trader. You will never find a successful trader that trades off of an algorithm fully and completely. And I know there's going to be people out there commenting, oh, I know a guy, or I am that guy. Bullshit, prove it. Let's see the way you live compared to the way I live. Okay? I don't want to hear it. I've been doing this a long time. I know what works and I know what doesn't. So these 3 do's, 3 don'ts, I know they seem really simple, but I'm telling you, especially if you listen to those 3 do's, you got this licked. Adios.